button on the Go to Webinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. This is Chris. It's May the 7th. Sorry, I'm a couple of minutes late. We got some storms outside and the internet's working a little bit slow, but let's go ahead and get started. Welcome to this month's webinar. As a reminder, the Power of the Patterns, your 30-second solution that we're providing visual solutions that you can see some action to be taken in a real short order of time. We know you're really very busy and see the messages that the market is presenting to us and action to be taken. Hey, I just want to thank you. Last month, at the beginning of the webinar, I talked about if I could do anything differently to make these webinars better for you, what could I do? And I just want to say thank you for all the feedback that we got. It was really positive. One of the reasons, I guess, that I ask about, just some thoughts is I know all of you are very busy, and I humbly, when I go to look at a webinar and I see that the webinar is 55 minutes to an hour and 15, it's rather intimidating. We're all busy in our lives, and didn't get lots of comments, but several said, yeah, if we could make it a little shorter, that would be great. And some of the other comments were, one of my questions was frequency. And so what we're going to try to do is make them a little more concise and make them a little bit more often based upon market conditions. We're still going to do the regular webinar on the first Tuesday of each month, but I am going to try to make them a little bit shorter, including today's, and then try to present webinars on a more timely manner based upon kind of some market conditions. So again, thank you for your feedback. As a reminder, every month is Kimble Charting Solutions is not bullish or bearish, other than we're bullish on opportunities. I do, as I shared before, think it's very dangerous to have a certain mindset that this is exactly how the world has to go. We talked in the last couple of webinars that you can either be a trend follower or a trend fighter. And I've seen more people be damaged by being the latter, the trend fighter. And they have all these macro reasons why this or that's not going to work out, and then the market goes against them. And then what do we hear? Well, the market's broke and yada yada. And the market, Mr. Market's never broke, just our positions, are. So again, I encourage you to just take the pulse of the market and be a trend follower to the best possible. So today in our shorter, concise environment, I kind of want to talk about long-term trends and how they remain up, but yet we're really in this giant trading range that we started discussing in January, February of 2018. Want to continue to share that I believe Fibonacci extension levels remain resistance. They're the key overhead factor in the markets, and that bulls would get a concerning message if we'd see selling start at the top of these extension levels. And then also share that commodities are showing weakness of late and suggesting, that or questioning, I guess, that global growth is going to take place. So as I just mentioned a little bit over a year ago in February of 2018, I sent if you were a premium or a sectors member at the time, I shared that due to certain conditions, I thought that we'd be in a trading range for many months. And we'll go over kind of why that was. But I just went back, and since that message, I went and this busy chart is not as busy as it seems, but since that message was sent, we've had a lot of up and downs, and I believe we are in this giant trading range until proven differently. But these were just some different performance. The top performer was a Vanguard fund that was ex-United States, and then you can see the S&P is a negative 0.08, essentially flat. Small caps down 1.76, the Dow down 267. Then as you went broader, the New York Stock Exchange is down 653, EFA still down 13, and emerging markets down 18. And that's even after this strong recovery of the first quarter of 2019. But I still think I want you to get in a bigger perspective of where we are in this bigger sideways chop. There's opportunities in the chop, and you don't have to take it negatively, but I don't think it's this giant runaway bull market's at hand, nor is there some giant bear market decline huge decline that's underway at this time. So it's more of this range boundness with a fairly decent, obviously, top to bottom. As we began the beginning of the webinar, I said that the long-term trends are up. We include this four-pack every week in our um, global trends report. And the reason I just say that I believe the trends are up is this is the S&P in the upper left, the Dow in the upper right, the Qs in the lower left, and the transportation in the upper right. And there's a lot of definitions of what constitutes a bear market, 20% or more, and I really don't want to get into uh, discrepancies or debates on what constitutes it or not. But I think the thing just to really realize, folks, that these key markets, as you all know, for a decade, have created a series of higher lows. Nothing fancy about that. And when you start connecting these higher lows, you'll see that the near 20% decline, or in some indices a little bit over a 20% decline from, let's just call it October the 1st of last year through Christmas, they did nothing more than come down and test these 9-year rising support lines. It looked like they could be broken, but in the bottom line is they hit that around Christmas and they reversed higher. So that's my basis for saying that the long-term trend is up. But at the same time, each of these are facing, when you see this 261 in the upper two charts and in the lower right and the 161 level, these are Fibonacci extension levels based upon extreme highs and lows of nearly 12 years ago. And with the NASDAQ in the case, the Fibonacci is based upon the 2000 high and the '03 low, and it's facing its 161 level. And so part of the reason that I shared, what are we now, 15 months ago, that I thought we'd be in this long-term, large sideways chop was I just based it upon what we saw at the 161 level, folks. And so this was based upon the highs in '07, the lows in '09, that when the S&P came up to the 161 extension level, it traded sideways. And now these are monthly patterns for almost 2 years. And I know it's a small pattern, but you'll notice it finally broke above it, came down, and then the ideal test was it tested old resistance that had been there for, let's just call it 18 months as new support, and then the thing took off to the upside. So it's not about being right or wrong, but this often takes place at these really key Fibonacci levels that they do grind sideways. In hindsight, we can see that this 20 to 24 month sideways trading range was nothing more than a base to push higher off of. So that can't be eliminated, that the same thing is happening again. The only difference so far is time frame wise. We're like 15 months in compared with 24. Now, is a 15-month sideways trading range enough to form a base or long enough in time? It sure is. But I humbly don't know how long that it could take, to finally resolve this. Other than, I think we just need to recognize that these extension levels, until proven differently, are the 800-pound gorillas of resistance overhead. And then there'd be nothing more bullish than the markets to be above these 9-year support lines and to take out the fib extension levels. So the jury's still out whether they can take the extension levels, out, but right now, until proven differently, that is resistance. A good friend Ryan Dietrich put the next two charts together, and this is a reminder. Just wanted to bring it up because this is the May Connect series webinar, and so the old adage, sell in May and go away, it obviously gets a lot of press, but when you look at the second chart down below, we'll just go ahead and look at it now. The top chart just shows that over the last 20 years, from May through November, Ryan showed is pretty much a sideways chop. So that would go along with what we've seen in the market for quite a while. And the statistics on the bottom are 6-month returns, or based upon 6-month time windows. And this is the May to October window. So even though the May to October window gets a lot of credit for being bad, you can see it's not necessarily bad, it's just boring and underperforming, with the best time window being November to April with an average return of 7%. It's higher almost 77% of the time. The May to October window is still higher almost 64% of the time. It's just that the gains are a lot more subdued. So I think we should just be prepared this is a normal time frame for even more choppiness, than what we've seen. And I think the big thing is a lot of people have tried to ride this market backwards. They've tried to fight the trend, and I hope that we're empowering all of you to see that you just go with the flow and the way things are versus having preconceived notions. And again, I've seen more train wrecks by people just saying, well, this is the way that it has to take place, or this is the macro, the way it has to unfold. And price is just the key, folks. So we'll just keep our focus on price and let that determine where we're going. One of the things that I want to say it's unproven, but there's the old adage that bottoms are more of events and tops are more likely a process. And so, when we go back to the 2000 highs, it took a lot of months before that was a double top, and then we saw the financial crisis unfold. But this is the Dow Jones Transportation Index. This pattern is not proven, but it does catch my attention that there's a potential, again, this is the monthly chart, a bearish reversal wick here that could form the left shoulder. And then there's a chance that that could be the head, and there's another bearish reversal wick. And then here's last month being the month of April, and we have another chance of a bearish reversal pattern or a bearish wick at the right shoulder. So to me, this pattern isn't ideal, that the neckline is stretched down here, but there's a chance in time we'll get a chance to see if this is a head and shoulders pattern. A large neckline would be taking place of the 2014 highs, the 16 lows, and then that quick big low that we had into December, and then the reversal. So what would it take to prove this pattern? It would take selling pressure, obviously, to start taking place. The only proof would come in is it would take a break of that neckline support, which is not drawn in, and then a way to disprove or break that I've wasted your time on this potential pattern would be a break above the 261 level. So we sure want to watch up here in the seasonal time of year that some of these key markets, as we see the S&P is back at last year's high. So one of the questions is, are we facing a double top? That's obviously far from proven, but the transports could be making a head and shoulders topping pattern that I want to make you aware of. And so here's the S&P. You can see it's just below the 261 level. I did highlight what we just discussed earlier. This was the trading range that went on for almost a couple of years below the 161 level. In some ways, it has a similar look of what we're seeing in the S&P currently. So this is a monthly chart. You see last month's close right here, which was almost at the same height of last October. So we could make a case, oh, we got a double top here. And what could eliminate that? It would be nothing more than a break above the 261 level. So we're definitely at the top of the trading range that we've experienced for the last 15 months. I didn't put it in today's webinar. You see it in each week's global trends. The one positive part about this market that would say so far the odds would favor a breakout to the upside is if you lean towards the advanced decline lines. The NYSE advanced decline line, the S&P advanced decline line, and the NASDAQ advanced decline line. They're actually you could say sending a bullish divergence message. And why would I say that? Is that they're at all-time highs, even though the markets aren't. So there is a slight bullish divergence taking place. So of any of the technical underneath kind of lift up the hood messages that are being sent by the markets, the advanced decline lines are sending a positive one, even though in the end I believe that these Fibonacci extension levels and the prior highs are more important than the advanced decline lines. We've tried to highlight that semiconductors, the technology since the 03 lows, has outperformed the S&P now for 16 years. So I put the leadership hat on the technology sector because it's been stronger for over a decade and a half. So to me, this is really important. The market was down, as you all know, yesterday being Monday the 6th, was down 500 at one point and came back to close close to neutral. And then today the market was down as much as 600, closed down around 500 from a Dow perspective, about 180 basis points on the S&P. But what has my attention here is the semiconductors. You can see at the top of the chart, this is semiconductors weekly, are the momentum's lofty and possibly turning lower. And so now the positive for the semiconductors is they did break above 2018 highs. This red pattern has a chance of being a doji star topping pattern 2 weeks ago, right here. We saw then another gain following that, and then we've seen some weakness this week. So the one thing that the bulls, well, here's what the bulls would love to see. They'd love to see semiconductors testing old resistance, which was the spring 2018 highs. After a breakout, they'd love to see semiconductors test old resistance as new support and it hold, and then a rally would take place from there. That's what the S&P did at its 161 level prior to a 50% rally in the year 2017. The one thing that the bulls would not want to see is that we see continued selling pressure due to momentum being lofty, and then this being nothing more than a fake out. Aha, we're breaking out and all things are good, and then all of a sudden now we're breaking down potentially at 3. So the remainder of this week and the next couple of weeks, what this line does at the 2018 highs at 0.3 is going to tell us a lot. We all know that the news is dominated by the trade wars. We're going to resolve, we're going to work with China, thumbs up, thumbs down. I think in the end, if you didn't watch any of the news, what's going to really give us the answer is price, because regardless of how the trade situation goes, we're trading price, and this is what in the end is going to be most important, folks. Another key indicator that we share every week in the global trends is junk bonds. Junk bonds has been on a bearish divergence signal, and if you can see that they've made lower highs inside falling channel 1 for the last couple of years, while the market's made higher highs. They tested the bottom of this support channel around Christmas. We've seen the counter trend rally. It hit the lower highs of 2018. It hit the top of the falling channel at 2, which also looks to be the top of apex of a bearish rising wedge, while momentum at the top is definitely at lofty levels and could be rolling over. So one of the signs that the markets could struggle up here, in other words, not succeed at this time in breaking above the 261 levels, would be if junk bonds would continue weak. One of the things that, speaking of junk bonds in this chart, the teal or turquoise line is corporate debt to GDP, and you can see when it gets lofty. Here was lofty in 2000, the year 2000, and also in 2008. Markets were obviously overvalued and experienced large declines. I think the one thing that's interesting, the yellow is the Barclays high yield average. That when you look, folks, this chart is we're embarking on 30 years. Look at the spread between the two. Humbly, I'm not exactly. To me, this is concerning. That the spread is this wide. In the past, you can see when the corporate debt to GDP ratio was really high, the yields on high yields were, you can see back here in 2001 reached 10%, and in 2009 they reached 18, and currently they're just at 4. And that's why I wanted to follow this chart with the prior junk chart, folks, is that if junk would start rolling over, there'd be a form of a catch-up here, which would mean that junk bonds would have quite a ways to fall if they started seeing some weakness. Because this is just an unusual task that the debt to GDP is this high, and junk bonds have failed to really go up much in yield, or in other words, fall in price. So I can't emphasize enough to keep your eyes on JNK and HYG, and also I show in the Global Trends Report each week the PIMCO High Yield Fund that The reason I like showing it, everyone, is it goes back clear into the late 1990s, so a long-term track record for junk. Um, Correlation between crude and stocks remain high, and so to me this is very important as the S&P, the Dow, the Qs, the Nasdaq are all testing last year's high. Crude oil essentially peaked at the same time as stocks last year, bottomed around Christmas at the same time. Crude oil, this is a weekly chart, so this would be this week, but you'll notice a couple of weeks ago we had a potential doji star right at the 61% retracement level, then a sharp rally that tried to break above the 61% retracement, only to form a very large bearish reversal pattern. This would be a bearish hammer or a reversal wick that took place, almost right here by the arrow, and then we've seen further weakness. So I think one of the things that's going to go a long way to telling us if this 261 extension levels can be taken out this time is going to be what crude does. And so here's an overlay of the two going back to last fall. So in the blue, everyone, is crude oil. In the red is the S&P 500, and you can see how they both peak together. And I apologize for a mislabel. I'll get that corrected. They both bottomed together, not peaked. Bad label, my bad. They both bottomed together around Christmas, and now they've rallied, potentially forming bearish rising wedges. And then you can see both are breaking support, with crude being the first one in blue to break its support line. So I can't overemphasize enough how crude could influence stocks if it heads south from here. So switching gears to then our next point is kind of how's the sentiment level as we're up testing the breakout levels, last year's highs, the Fibonacci extension levels. This is the percent of indicators showing excess optimism and pessimism. Typically, this indicator, in my opinion, is best, as with a lot of sentiment indicators, at lows compared with highs, because lows are more close, as we said earlier, to be events versus processes. But you'll notice that the last February low and the Christmas low took place when this indicator was very low, which reflected very few indicators were expressing optimism and many indicators were expressing pessimism. So right now, the opposite is taking place. This piece from Sentiment Trader, I believe, looks at 30 to 35. Forgive me for not knowing the exact number. A large number of different indicators, which would reflect that the majority of them right now are showing excess optimism and very few are showing excess pessimism. Now, there were times when you look back here to 2017, you can see that the indicator was high, but the market didn't struggle. But then you can see last year's high took place here, and then the October highs took place here, and so we're definitely at lofty levels that from a historical perspective, this when the spread is at the current conditions, markets are most often closer to highs than lows. So this is then a different indicator, but along the same line as smart money, dumb money. This is just to show the individual indicators. The dumb money's in red, the smart money in blue. Right now, the dumb money is very confident. They're actually at the most confident levels in over 15 months. And then smart money is close to or at the most concerning level over the last few years. And then in the lower right is the combination of the two. So you can see that right now the smart money, dumb money spread is at the lowest levels since 2017. But you can, let's also, this is a similar indicator, folks, that to me this is better as bottoms, predicting bottoms than tops. But I don't think you can ignore it. But here was last January's high and last October's high, and you can see we're lower than that. But at the same token, in 2017, when it was down this low, the market, you can see right in here, did not fall apart. So again, this is an indicator that more often than not, markets are closer to highs than lows when it's here. But again, the best market timing tool is using price itself, on the indices. This is a combination chart of the 10-year yield on the bottom and the S&P 500 on the top. And my, the thing that has gotten my attention the most is that yields have obviously been creating lower highs for 25 years. They've peaked at this falling resistance line. Stocks and yields peaked in 2000. Right here, you can see in 2007, they did it again here. And then last fall, yields and stocks peaked at the same time, as yields were hitting this resistance line. And so to me, the takeaway here is while the S&P is testing last year's highs, yields are actually testing support. So we have stocks on the top testing resistance, yields on the bottom are testing support. And I believe yields will probably tell us the more important message that, in my humble opinion, I would say that if yields would fall at 1, stocks are closer to a peak at the top. So the ideal yield scenario for stocks would be that they do not break support here and they actually rally off of it. If yields would rally here, it would increase the likelihood that the S&P takes out last year's highs and can take out the Fibonacci extension levels. But if yields would break support here around the 240 level in the 10-year yield, I think stocks would see further weakness. So to me, a real important line in the sand is taking place, in yields. So switching to kind of some messages for the next few charts before the ending of from the commodities sector is copper. Excuse me. This is Doc Copper. You can see in the longer term since 2011 we have a series of lower highs and lower lows. But for the last over a year, it's in a trading range. But you can see for months it's been banging up against this resistance around the 295 level. And then just in the last few weeks, we're seeing it starting to roll over as momentum is somewhat lofty. It's rolling over as well. So Doc Copper, if Doc Copper has any credibility in today's world, the decline in Doc Copper would be suggesting not a massive, but a potential flattening of the global economy or potentially slowing down. Now, if copper would come down here and break support at the 250 level, which is still another 8% decline in copper, if copper would break support level 1, that would suggest definitely a slowdown in the economy, and I would bet rates would fall and stocks would struggle. Here's another piece, what it's suggesting on the interest rate front. This is the copper-gold ratio. Interest rates in this ratio are highly correlated, and you'll see weakness of late taking place, and the ratio is breaking support. So trying to put the last three charts together, which are yields are testing support, copper is turning weak, the copper-gold ratio is breaking support. This is a theme that I want you to pay close attention to, that even though interest rates are low, if they continue to head lower here, I would suggest that stocks are probably going to head lower themselves and struggle with the last year's highs. But again, the bullish case for stocks would really want to see yields go up, copper go up, and the copper gold ratio head higher. And I apologize, I got a couple of these charts. I should have shown this 3 charts ago, but this is one I showed a couple of months ago. But this was last fall. You can see we printed this back in November. That this is when rates were actually hitting that resistance line. This is before the fact. This is before the 20% decline in stocks, and that's why I just can't overemphasize keeping a close eye on yields. And so yields ended up breaking down, and so did stocks. And so I apologize on the order of those slides. So here's that same slide again, just to reiterate how important a support test and yields are. So as breakout tests in the key indices, we said, the advanced decline lines are breaking out, but most of the major indices are still below last year's highs. They're testing last year's highs. The bull case for stocks don't want double tops to be taking place. This is just a reminder going back 120 years this is I don't believe, folks, that there's any one holy grail valuation indicator that's the best by any, or the holy grail. And so I like this is from Advisor Perspectives, the Doug Short part of their website. Jill puts these great charts together there. Jill's most recent chart here shows that the combination of four different valuation indicators have it about 96% above the 120-year mean. But just for perspectives, here's where we were in 2000. So obviously it's not as high as 2000. But here's where the evaluations were in 2007. There's the financial crisis, and this is where I happened to be lucky and get into the business in 1980 when it was below the mean. So this is where I still believe that we're not in a Bahama Mama sip your drink, buy and hold marketplace that you can just put it in, be long, and forget about it. With valuations this high, you need to be more tactical, be ready for shorter term positions, have your stops being tight, and understand that some selling can definitely take place that can be painful from a buy and hold perspective with valuations this high. So as a reminder, I'm going to do a little separate piece on this, but these are the stocks that have performed the best in the month of May. Even though the idea of sell in May and go away is in play, seasonally wise, you can see that the month of May has had a median return over the last 10 years, the S&P of about 156. And you can see that there's several stocks that have done really well in the month of May. And what I'm going to do here in an upcoming report, probably a coffee with Chris, is that one of the things, if you'll notice, I think I've sent this out twice now in the last 2 weeks sectors report. But this year I started including what sector these stocks were from. But if you'll notice, here's a healthcare. As we come down, there's a couple of more healthcares along the way. So I think seven of the 20 are from the healthcare sector. And so nothing has been more disappointing of the S&P 500 sectors of late, last 60, 90 days, than healthcare stocks. So what has me intrigued is they're not doing well, and so several of them are testing some support levels. So the trend is not impressive, but if the market would happen to behave, there's a chance that these healthcare stocks that are oversold could attract some momentum dollars. But they're going to have to prove themselves before I'm going to suggest any recommendations of them. But I just kind of wanted to point out that that theme could come back to be a positive. Until it does, it's actually a negative in my opinion because of the weakness of healthcare stocks. But there might be some potential bargains in these seasonality, stocks in the month of May. But we'll see. So I want to finish with something I'm really excited about, folks. I've hired an engineer and his firm out of California, and I just want to think of this as the new chapter for Kimble Charting Solutions members. We're building in the background, and I still suspect we're at least 60 days away, but I want to let you know some exciting new things that are taking place behind the scenes. We've upgraded our servers. We've tried to upgrade the speed of the website because of us getting bigger and going to provide some more services. But within 60 to 90 days, we hope to have an entirely new privatized membership section of the website available for you. That the intent is that you'll be able to sign in and see the reports that you've subscribed to. All of the reports from the past will be there, so you don't have to store them in your hard drive, or anytime if you'd want to look back on a prior report, they'll just all be there in chronological order. Webinars like this, our intent is to put them on the website that members can go and click and view the current one or ones of the past. Any messages, personal messages to members will also be available on this website. And there's a few other surprises that I'm not going to bring up, but I'm excited that it looks like that we're going to be able to do for members. And so this is something I've wanted to do for quite a while. And so we're getting closer. All the software has been purchased. The engineers working very diligently and hard to get this up and running. There's going to be a learning curve, so I do want to say I'm going to ask for some forgiveness ahead of time, because I know there will be some that just can't help but be some glitches. But please understand that we're doing this for the benefit of members, and I believe you're really going to like what you see, when it's done. So I'm kind of excited here. I might be ahead of myself, but I really wanted to share that this is what we're working on for the benefit and appreciation, of you as members. So in kind of wrapping up today, the long-term trends remain up, the top box there, as trading ranges continue. The Fibonacci levels do remain heavy resistance. And, just because we saw some selling yesterday and some selling today, doesn't mean that the rally off the Christmas lows is over. But I will say this is not what the bullish case wants to see, as it's testing last year's highs, especially with some sentiment indicators being as high as they are, and weaknesses in commodities being gold, copper. The copper gold ratio would are putting growth, or macro growth, in question, whether it's going to happen. And in the end, if commodities are speaking the truth, that the slowdown is could be around the corner. If interest rates head lower, it would probably, to me, the odds are going to be hard for the stocks to break above those Fibonacci extension levels. So wanted to try to make it a little bit quicker today for everyone. So I really appreciate your membership. Again, we got some really fun improvements, coming down the road, and I'll look forward to seeing you the first week of June. Happy summer, everybody. It's going to be here really quick. Thank you for your attendance and your membership, and we'll talk to you again soon. Thank you, everyone.